Thank you all for being together for this webinar today on an important topic, how to measure ROI of the human capital. And we have some predefined things to discuss: why human capital ROI, what kind of models are available, and the investors focus on the human capital measurement these days, how to convert intangible to the tangibles. This is a key component in the overall measurement process, how to measure the ROI, and the last part, how to demonstrate the impact. So our goal is to make it kind of a dialogue where I'm going to deliver the presentation. And then I'm very open to have it, to respond to your comments or the questions. So please feel free to have a conversation in the form of a chat, and I would be happy to respond to it. At the same time, my request to everyone is to please mute yourself so that there's no disturbance to others. So hopefully, and we'll try our best that this is a very conversation and engaging program. This program, as you know, is taking place from the HR Metrics platform. And HR Metrics was created on a philosophy of connecting the dots between the HR performance and on the human capital performance, obviously managed through the HR department, and its linkage with the organization performance in the measurable terms. We have expertise in some of the areas, including the data analytics, the SHRM, HR competencies and certifications, global diversity, equity, and inclusion, and also the HR standards. So these are the broadly 4 areas which we pursue. My name is Zahid Mubarak, and I'm the facilitator for this program today. I'm leading this company, HR Metrics, and also had the honor of introducing the competency-based qualifications and the certification in Pakistan. HR standards, which might be a new terminologies for few of us, it was started in 2011. And for the first time when the ISO started the HR standard work, so only 11 people from only 11 countries were invited to the Washington. Fortunately, I was one of them. Those countries were US, UK, Germany, France, Sweden, Switzerland, Austria, Norway, Netherlands. And I represented not just Pakistan, but the Asia over there. Past couple of years, I had the opportunity to speak at the various forums in the face-to-face environment, including Washington, London, Melbourne, Rotterdam, Paris, Singapore, Bali, and Milan. The global standards on the data analytics was rolled out by the ISO, and it was developed by a committee which was called TC260, Technical Committee 260, and I'm the member. Also had the honor of serving as a chair of the working group on the HR standards, the HR metric standards. And during my leadership, ISO published 2 standards, the quality of hire and impact of hire. Apart from that, I have a deeper interest in the global diversity, equity, and inclusion, where I have facilitated 49 organizations in Pakistan, and I'm also a publisher of one of the magazine called Workforce Tomorrow. So with this background, I just want to have your thoughts and your say into this process. Please be candid in your opinion. There's no judgment involved. I genuinely want to understand your thoughts as to what extent you agree with what we are doing. People are our most valuable asset. How many of you have heard this statement in your career? Please raise your hand. In your life, in your professional life, how many of you have heard this statement in this form? People are most valuable asset. Okay, interesting. Is there anyone who has not heard? Please keep raising your hand. I want to know that if somebody has not heard about it in the past. So the frequency of the hands which have been raised, it shows that I think majority of the people, most of the people have come across the statements. Okay, please put your hands down. The next thing where my question is that how many of you have seen the truth of this statement, where some form of equation or some measurement where you could see that, okay, this is an asset. And you understand asset is not the HR terminology, it's a financial terminology. And it means something payback, some return for the organization. So how many of you seen this thing in the form of an equation where you could see that this is the spendings and this is a financial return in a measurable terms? Please raise your hand. I want to have a very quick opinion. Emin, you can lower your hand. Sadia, since you're part of our team, I think so, Emin and you most frequently would be hearing this thing and would be familiar with this. Now, I want to hear the opinion of Usman and then Muhammad Ali. In what form you've been able to see the demonstration of the real, human capital as an asset in the organization? Please have your thoughts very briefly.
Most of the time, Zahir Saab, it's based on the outcome. When it comes to, by the way, let me be very clear about it. When I raised my hand, it was partly, it was something that I partly agree with. The main reason is in many departments like sales, where the outcome is tangible. Yes, that asset kind of an equation does apply, but not in every department or on every seat it is being measured as such. That's my opinion on it.
Mm-hmm. But thank you. Have you ever seen in some evidence-based manner where there's a measurable, some kind of calculations, right? That this is for example, you are doing a training and you see that, okay, this was the dollar value, or this was the Pak rupee which was spent on the training, and now this is the return. Or in any other function, have you seen it before?
Not in every case, to be very honest.
Right. Okay. Thank you. Okay. The other fellow, Muhammad Ali bin Shahid. Thanks, Usman, for your thoughts. Ali, I also want to hear your opinion.
Assalamu alaikum. I think what Usman was talking about, I have similar experience of working in the organizations. The thing is, wherever the sales, which can be done tangibly, tied up with the performance or whatever trainings or etc. with dollar values are concerned, they are being communicated in terms of any kind of metrics, but not anything else. So my experience with this HR metrics has been that it's mostly pertaining to what can be measured in terms of sales, etc. But things where services or intangibles are concerned, no.
Great. Thank you so much. I think that's the reality. If some of the functions like the sales, where they can clearly demonstrate their performance. And that is the reason you would have seen that people like sales, the commercial, they have a huge say on the decision table. And they are being heard most. So that is actually the gap. Now, that does not mean that it cannot be measured. It can be measured. We have worked with the companies. There are global frameworks. There are some of the companies who got into this framework. They're using it. So we are going to discuss that. So the outcome of the discussion is that there's a huge gap. And I'm sure that all of you are together. One of the key reasons is that you want to overcome this gap. I know some of my fellows from the different countries like Ukraine, or maybe in Azerbaijan or few others where language is an issue. So I'll try to speak as slow as possible, but still if there's some difficulty, so I seek your apology for that, because I'm not aware of the languages either. I definitely would have facilitated. I know that when I was conducted a training in Russia, so we enjoyed the privilege of having a translator but I think that facility is not available over here. Okay, so what you're saying now, that is exactly the findings and opinion of a global survey. You would have heard this terminology ESG very commonly today, where they're trying to look at the various components, the ESG. And you would also agree that whenever it comes to ESG, the first and the foremost focus is on the carbon or the environment. Over there, the question is that is, the hunger, social issue, the social deprivation is more important than the forest. The question is, the first is the human, and then is the rest of the word. So in the ESG context, the S has traditionally been found with more of an activity-oriented things, where we try to do something, but we are not able to determine leading to what. For example, you are looking at the diversity, or you're looking at the training. So in most cases, the people are showing how many number of training of hours are there, how many people have been trained, or how many diverse segment of the workforce have been hired. But the investors focuses on leading to what, because there's a dollar spending on everything you do in the organization. So what is the return on that? So before discussing the topic, I would like to give you some context, the broader context, because we need to position our dialogue in the overall global developments, how it fits into the larger framework. These days, the larger framework is the ESG. As you know, it stands for environmental, social, and governance. And one of the reasons for the ESG is the sustainability. How, as an organization, as an individual, we can stay relevant, we can stay current, so that we are sellable and we take care of the needs of the market, and people are willing to hire us, people are willing to buy our services, people are willing to buy our product. Sustainability, again, these is a common word, but instead of going to the description, I would like to show you the real impact, how it is hitting the company. Some time ago, I was trying to explore that how this sustainability is, impacting the organization. And I found a very good video on the YouTube. I took a glimpse of it. It was showing that within a span of 20 years, the configuration of the Fortune companies has changed, drastically. We take a snapshot of the top 10 companies. Almost 80% of them have changed. Just two are, existing, Walmart and the ExxonMobil. Rest, every company that was not there previously. Even Walmart, that is basically a retail company, but that doesn't no more rely on the counter service. They provide a service at your doorstep, where your experience, your employee experience is taken into account, and decision to get into a repeat business, or to terminate that experience is basically depends upon how you treat your customer. So this is an important finding in the global context. At the local context, within Pakistan, since we are operating in Pakistan, see the composition of the companies in a span of 10 years, 2009 into 2020. In a span of 10 years, see the number one company which was there in 2009, in 2020, even what to talk of top 10, even it doesn't exist at all. So I'm not getting any kind of criticism. I'm not getting any kind of evaluation. This is just to give you reflection. This is how the world is changing. And this is impacting everyone's life, our careers, our choices, our economics. So there's a big reset. There's some phenomena working behind this process, and this phenomena is that the economy is constantly transforming. I give you an example of the Walmart, not just the packaged material they produce the customer experience. And that translates into a future business for them. Amazon, see, you don't find that any, typical retail outlets in the market, but they are leading the global business. So in this process of global business, where customer experience is based on the workforce, their expertise, what kind of convenience they create, what they can do to, to meet and surpass the needs of the customer. That has become a recipe for success. And there's a stunning finding. This is a stunning finding by an organization in the United States, which is called the Ocean Tomo. They carry out analysis of the 500 Fortune companies. And this finding is why I call it so stunning, that it's completely changed the landscape of the business around the world, this finding. And that this finding is that the more than 90% of the value creation these days in 500 Fortune companies comes through the intangibles. That's the strange findings. So more than 45 years ago, the intangible was less than 17%. There was a huge reliance on the tangibles, the plant, equipment, vehicle. But now that emphasis has shifted. So this is forcing the organization, the investor, to rethink about their, the risk assessment, where they should invest and where they should not invest. And that is the reason that ESG framework has come up, and the board of directors are now under tremendous pressure by the different stakeholders to take certain measures to, convert their organizations, to change their organization, to make them more responsible organizations if they want to survive and sustain in the industry. So the ESG is considered to be a pillar of sustainability. And within the ESG, the social aspect, the S, is considered to be a center pillar. I'm not saying so. It's a various school of thoughts, including the Harvard Law School has a clear article on it, that unless you do not put the S in order, the environments are not going to work. The governance system, the human governance system is not going to work unless your social aspects, including the human capital management, diversity, health and safety, human rights, value chain, society, labor, child labor. These are some of the aspects which can be seen at the top, but then there are a lot more below that. So a concept of this worldwide, a concept of the stakeholder capitalism has come up, which is a departure from the previous shareholder capitalism. I'm trying to share with you the context of what we are talking, because understanding the context and positioning yourself with the strategic aspect of the overall activity is very important. So is there anyone in the group who can help me in clarifying this concept of the stakeholder capitalism and the difference between the stakeholder and the shareholder capitalism? I would be grateful for that support. Anyone who can help me with this? I don't want to name anyone, your choice. If you're comfortable, let me know. Otherwise, I'll do so.
I think in terms of Zahid, my understanding is, and I may well be off the mark, shareholder capitalism is about basically focusing specifically on the needs of your shareholders only. Stakeholder capitalism is basically about looking at everybody who is a stakeholder in running the business, which would be not just your shareholders, your customers, your employees, your vendors, the community in general. All of these are basically stakeholders. So that's, as
Absolutely.
I see, that's basically how I see the difference.
I think you're absolutely on the mark. Thank you so much, Aisha, for the very precise, the definition part. Is there anyone who further wants to elaborate or, make it another point?
Additionally, I think shareholder capitalism is including in itself just one or two publics related to the specific business. On the other hand, stakeholder capitalism includes 20 plus publics associated with the business, the same like Ms. Aisha said.
Wonderful. Thank you so much for the supplementary thoughts. So you're absolutely right. So one is your shareholder is your, the investor in the organizations. Traditionally, in the past, is for the key main stakeholders, but now the concept of stakeholders, you have your employees who are the main stakeholders. And it's not just in the form of a lip service, there's empirical research on that. And I want to share with you that there's an article, I can share with you the link, based on a research in the classic organization where they could see that earning per share doesn't really tell you something about the future of the organization unless you are able to see it with certain intangible indicators. For example, you had a better earning in the past, it doesn't promise you something. But if you have a stronger employee engagement, if you have a stronger skilling, better workforce skilling, if you have stronger retention, and everything else is normal, it does reflect you something about the future potential. So in this ESG context, the shareholder capitalism, stakeholder capitalism is a new philosophy where all the stakeholders, including the shareholders, you have the employees, your regulators, the community in which you operate, they are the key stakeholders, your labor associations, anybody who is impacted with the operations of the organization as a stakeholder in this process, and the organization need to be transparent, need to be responsible, and need to have a measurable mechanism to demonstrate their responsibility towards them in a proactive manner, right? That's the concept of share. So the ultimate aim of discussing overall this process is that investors who is injecting money into this process, they want to see the risk assessment. And traditionally, there is no risk assessment framework for the HR. It's more seen in the form of the headcount. How many people have been hired, how many number of people have been trained. And I've shared with you the findings of the global survey. So this problem has been seriously felt by the stakeholders, shareholders, and they feel that there should be something stronger on that side because of the reason that traditional system of accounting, which was based on the more of tangible things. I have shared with you the findings of the Ocean Tomo that accounting has lost the balance. How it's lost the balance? You have this interesting findings with you, and that is the reason that the worldwide accountancy bodies like IFRS, International Financial Reporting Standards, they have consolidated to create new standards, not just accounting standards. They call ISSB, International Sustainability Standards Board, and the bodies like SASB in the United States, Sustainability Accounting Standards Board, International Integrated Reporting Council in the UK, they merged together to form a new council, Value Reporting Foundation. Purpose of this whole exercise is to take a holistic look at the disclosure framework and the measurement framework so that you are able to give a true picture about the future of the organization. Now, what is forcing us at the larger level to think about it? That European Commission is revising its non-financial directive. International Organization for Security Exchange Commission has set out intentions to accelerate the harmonization of the sustainability standards. One of the reasons is that in Pakistan, in past months, you have seen that SECP has published a ESG roadmap for the next 2 years. I'm a member of the ESG task force by the Pakistan Stock Exchange. So the task force is working on some of the future disclosure framework. US Security Exchange Commission has played a leading role. They've already amended its disclosure framework, and they're further looking at to make it more rule-based. International Financial Reporting Standards, IFRS Foundations, has agreed to consult on the broadening its mandate to include sustainability issues. International Federation of Accountants has called for the creation of an International Sustainability Standards Board that I've told you to sit alongside the International Accounting Standards Board under the auspices of the IFRS Foundation. The leading voluntary framework and standard setters, including Climate Disclosure Project, Climate Disclosure Standards Board, the Global Reporting Initiative, International Integrated Reporting Council, Sustainability Accounting Standards Boards have set for the first time committed to work towards a joint vision, that's the sustainability standards. These developments form natural building block of the single coherent global ESG reporting framework for sustainability of the corporate value creation system. Now, why I'm discussing all this stuff? It's very important for the human capital people at any level, may it be the board HRC committee, may it be the CHRO, may it be the operation management, even the new entrants, to see a clear line of sight between what they do and how it impacts the society at large. And the line of sight is through this process, how you can create value and how you can demonstrate that value in the measurable terms. So some of the reinforcements in the backdrop of these developments, the Larry Fink, those of you who have interest in the ESG know that this gentleman or this company, BlackRock, owns more than $3 trillion assets. So the letter to the CEOs by the Larry Fink clearly indicates, don't leave the S part unless it's properly measured and pay full attention to the human capital. So that in the backdrop of these developments, now the ESG becomes an agenda for the board of directors. It's become a full-fledged competency. We are also initiating a separate ESG forum for the board directors, because in the traditional circumstances, such kind of competency is considered to be learned or the born qualified. That's not the case. You learn finance, you learn IT, you learn medical, you learn engineering. So all these things they have a formal learning framework. So we are taking certain interventions over there. This is the broader mandate of the ESG, where certain metrics are required on the environment, social, and the governance side. And there are different frameworks. What I'm showing you is one of the framework by the KPMG. They promote this thing. The World Economic Forum also has a set of 21 core metrics, and I think another set of expanded metrics to talk about the governance, the people, planet, and the prosperity, which in the nutshell is the ESG. At the country level, there are now the regulatory reforms, and they've given a roadmap. So they have issued so the roadmap for the next 2 years, how this is going to unfold. So there's a greater opportunity for the HR people to connect their work, because traditionally, one of the complaint or you can say the concern by the HR people is they're not being heard. They're not being taken serious. So how you can create your seriousness in your work so that you are taken serious by the top people. So this was the background that I wanted to share. Now coming to the why to measure human capital, and then we go to the how to measure. I know there's no disagreement on the measurement. There's a more issue is with the how part of it. So I'll be talking about, first of all, very briefly, why part of it. I think there are various triggers in the various parts of the world. One of the specific trigger comes in 2017 by a group of 25 US institution investors with an aggregate of 3 trillion assets. They sent a formal application to the Security Exchange Commission. I have a copy of that application. They wrote that we want a clear disclosure framework. We are not interested in the headcount. We are not interested in the number of training. Tell us, how does it correlate with the organization of the financial outcomes? The Security Exchange Commission, they took their time of making a public rules, and on 26 August 2020, they have issued a regulation which is called SK regulations. It's an old regulation, but they modified with the principle-based disclosure, where they left it to the organizations to decide what is critical for their business, what is material for their business, and they must disclose. And now, most recently, they're considering another rule, which is more rule-based, where they're not leaving it to the organization, they are telling the organization what to report and what not to report. I think in the past 2 weeks, there have been an interesting article shared with the groups where a group of experts in the United States working group, they sent a formal petition to another petition to the Securities and Exchange Commission, and they also discussed the framework, how you can demonstrate the human capital asset on the financial statements, because the organizations are driven by the regulatory framework, and regulatory framework is basically developed by some of the global standard setters. So unless there's a modification over there, the things are not going to change. But at the same time, the thought is that in order to perform something, you need a push, something in the form of a compliance. But I also have a feeling that if you feel something is good for you, it's not necessary you wait for the compliance. For example, you know that seatbelt is good for your traveling. It provides you safety. So as a good practice, good people do not wait for the police or the cop to watch them and they wear the seat belt. That's not the case, because seat belt is meant for your safety. So even it is not the regulatory compliance, even if you're not on the motorway, if you wear the seat belt, it would be beneficial for you. So they have demonstrated the framework. How that framework works, very broadly I'm discussing. I'm not going into the nuts and bolts to discuss that framework. They equate the human capital like an asset. If you want to read it, let me know, I can send you that article. They say that in a traditional framework, you acquire a fixed asset. For example, you buy a car for your organization. And you, before buying something, you see that there's an opportunity, but there's an opportunity cost. Why you would like to buy a car for your organization? There's a need for it. And if you don't perform that need, there are losses to the organization. So that in order to overcome that opportunity, you buy something. And in that process, you have a cost, which is called asset acquisition cost. In case of HR, you have a hiring cost or some other cost. Then that asset, whatever you buy, has a useful life. For example, you say the car has a 5 years depreciation and its useful life is 5 years, but that's not the real case. Have you ever seen a car becoming zero practically after 5 years? Has anyone seen the asset coming to zero after 5 years? Anyone? Would somebody like to respond to it? Because I want to make sure that you are.
Actually, it's a wonderful point to be thinking about, especially when we talk about assets that they don't have a point that their value becomes zero. So how can that be the case for a human who is constantly evolving, learning, developing, and going ahead in the career? So I think it's more of a reverse in this scenario.
Yeah, the person is progressing, it's not depreciating. It's not depreciating. The person is progressing with every passing day. The proficiency enhances and the organization contribution to the organization becomes better. But even if you think that every person in an organization has a certain useful life in the form of, you can call it the retention period. And for the sake of calculation, you always have to take certain assumptions, because in the absence of assumptions, the things do not work. So the asset has a useful life. The person also has a useful life, and you can take the average retention period of that particular cadre, that particular department, and make certain assumptions. And assumption, as I told you, that if you are applying depreciation on an asset, I have never seen an asset becoming zero after 5 years, but it does happen on the books of accounts. So if that is applicable over there, why cannot be applicable over here? These are the arguments in that article. And then that asset has a payback, and you record the payback. There's a payback when the person performs in the organization. So all the things are doable, as long as you have the intent and you want to perform with some judgment. Judgment is always there. Remember, there is no, you can say, steel jacket of making any calculation in this. There's always a judgment. For example, you're traveling from here, from Islamabad to Dubai, and your judgment is take 3 hours flight, and the airline operators, they write on your ticket 3 hours. You never reach in 3 hours. It could be 3 hours and 10 minutes, 3 hours and 15 minutes, or maybe 2 hours and 45 minutes. So, but judgment is there. So using judgment with some kind of calculation is a baseline for your this kind of positioning your human capital as an asset. So this I told you in a more of a construct form, that how this is being proposed over there. But that will take time to materialize. On the other hand, there's a global standard, and I'll talk more about it. It has already come up with a framework of positioning the human capital, and some of the leading school of thoughts are considering this framework to take it to the some kind of a, there's already a global standard, but the things become more enforceable when they come through the financial bodies, like the sustainability standard, the accounting standards, because they are the one who are leading the overall disclosure framework. Okay, so we'll be open to have more conversation around that. Now, I've shared with you this framework for measurement, but actually the measurement framework was developed in 1969 by a gentleman that was called, that he's still alive, and I wish him very good health. His name is Jack Fizens. He's written a book also, Human ROI, the Human Capital. where he equates the human service like in any other service, any other product. And every product has a typical 5 dimensions. For example, you have this, I have this cell phone with me, right? So whenever I want to buy this cell phone, I would always ask, what's the cost? And if there's an opportunity to buy one for one free, so I would prefer to have 2 cell phones on the same cost if there's an opportunity, right? So volume matters. Then the time for delivery. If somebody tells me, okay, you have this half the cost, but the phone would deliver in the next 2 years, I would be reluctant to buy. So your time matters. And when you buy something, your experience, your quality, and the quality has certain parameters. For example, one of the parameters of this that it says that it should have 12 hours battery time. Does it really provide the battery time? And when I'm going to experiences, the user satisfaction, and I can have 2 opinions, the positive experience or the negative experience, that also counts. And finally, the purpose. If I purchase this thing for a commercial activity, I would like to say that how much is the investment and how much is the overall benefit. If it's a non-financial, then even my pleasure that I get from this process is sufficient because I'm not purchasing it for the financial purpose, right? So these are some of the parameters. I'm coming to you. I think you have raised your hand. I'll coming to your point. So based on these 5 parameters that gentleman clearly written, and there's a clear explanation that you can consider any of the human capital process, maybe hiring, engagement, compensation, relations, and apply these metrics. Everything is measurable. For example, you talk about the hiring, you have to measure the total hire, total cost, total time to hire. But first 3 metrics are more of activity metrics. They are being done by most of the organizations. The issue comes when you go to the effectiveness measurement. There's a lot of fuzziness, a lot of narrative, a lot of description. You have to get out of that narrative, make it more measurable. For example, in hiring, you say, what is the new hire retention index? What is the performance index? And finally, the ROI, which we'll discuss, where you are able to see clearly beyond description that dollar invested in the hiring corresponds to how much return. So this is a typical framework. And I have used this framework. I've worked with almost 30 companies. It is doable. There is a rigor involved, rigor in particularly beyond first 3 metrics. It's just like accounting and finance. Accounting is easier to be done. You just have to do the bookkeeping, the vouchers, and the daily reconciliation. But when you have to make a profit and loss statement, when you have to make a cash flow statements, you have to do some analysis that require more rigor. But then there's more reward with the rigor, right? Because you are respected more if you are a financial analyst, right? So the things are there. So model was already there. Okay, over here, I'll take a pause and would like to take a question or comment somebody wants to have. I think someone raised a hand or there was some comment.
Actually, I raised my hand if I have the permission.
Yeah, sure. Go ahead. Go ahead.
This is a very, very interesting topic, measuring human capital. And we see quite a few comparisons drawn towards machinery and fixed assets, right?
Mm-hmm.
And typically when we talk about making the most out of an asset, we take it to an extent then that the asset starts to wear out.
Mm-hmm.
When we talk about human capital and when we talk about return on investments, it's a very fine line that we need to be mindful of, that where do we stand in terms of our wellness regime and our return on capital.
I agree. That is why I told you in the beginning that no one disagrees with the statement. The people are most valuable asset, but where is the real truth? The fact is that in this word is being ruled by the accounting standards. So in the first instance, what you are saying has to be accepted. And for your acceptance, you have to put yourself in certain framework and demonstrate, okay, with your goggles, with your glasses, even if put ourselves in your framework, this is how is the payback framework, right? Otherwise, there's no disagreement. I was having a conversation with my Japanese counterparts. We have our company partners in Japan. Unfortunately, we have certified 103 people over there on a global standard, that are Tokyo, where they say that we are not interested in the ROI of the human capital for the reason that it is obvious. Because when you invest in somebody, like the Chinese say that if you want to have a 6 month return, you invest in a crop, 10 months return, invest in a tree, and you want to have a 100-year return, invest in a human being. The point is that obviously there's a return. Return is there, no one denies. But important thing is that how you're able to demonstrate. So just having agreed with you, still we need some kind of framework to demonstrate. And currently, since the accounting and finance framework is prevalent, so there's an effort to put even to demonstrate your evaluation according to their framework, because it is showing you certain returns, it's showing you certain payoff to the organization, so there is no harm in doing it. And I wish the time comes that people are not interested, like I told you, the Japanese mindset, they are not interested in just, but the investor mindset would always there. Put yourself in, and for example, if you have today a $10,000, you want to buy a share, you would not like to look at the the employee engagement or the training of a company. You would like to say, where is the more ROI on the your share prices? So wherever you get a better return, you put your money over there. So that is the reason that there's a focus is to position human capital as an asset in the real term. I hope it answers your question. Okay, I think I'm not able to hear your feedback, but still, if there's something we can take on subsequently. Okay, right now, taking the debate toward the further ROI, we have to keep in mind that the organizations are governed by some of the the three key parameters: the income statement, which you also call the profit and loss statement, and the balance sheet, which show the assets and liabilities, and the cash flow statements. So in your profit and loss statement, which is called income statements, you have two broad areas: your revenue and expenses. And the revenues are further divided into revenue streams. The expenses are divided into the various segments of the expenses. And then there are certain other elements like the taxes, depreciation, and other things. So when you are investing in the human capital, it can translate into one or two things. Say, if you build the capacity of your salespeople or production people, they would perform better. Your production would enhance, and your sales would increase. It would generate more revenue. Your profitability is going to increase. If you invest in your employee engagement, your retention improves. Your opportunity cost of the retention, because opposite of retention is the turnover. So whenever the turnover is there, there's a rehiring, retraining, so many other expenses are there. So that opportunity cost drops, expenses reduce, and it impacts your profitability. So this is the financial model. And we are not challenging the financial model. We are looking at the existing financial model, looking at the profitability, that investment in the human capital is going to impact one or both component of your profit and loss statement. And then it should logically translate into the net earnings, net cash, net benefit to the organization, because that is where you can differentiate. So now that there's a focus on the ROI, there are also few trends where the organizations are plotting the ROI of the human capital in their overall financial statements, where they can see that if the trend is positive mean that today, if you have a 50% ROI, in next year we have a 75% ROI, you would like to inject more. But if it is on the reverse side, that opens a question: what is fundamentally wrong? It's not always that more investment in the human capital translates into the more outcomes. You have to see it's not only the amount of spending, but how do you spend and where do you spend comes. So logically, you should be able to see this relationship in the form of the balance sheet, where you can say, yes, it is translating into the outcomes or not. Otherwise, no one is going to listen to you or take you seriously. This is the logical framework where you say that, for example, you have a better employee experience, and you take certain interventions in the HR on account of the learning, autonomy, supervisory support, climate of respect, work-life balance. It translates into better engagement, more job satisfactions. People stay longer in the organization. And out of the people who stay longer, those who are performers, they cooperate with each other, they devote extra time, they adapt to the change. That creates a positive customer experience. The positive customer experience creates more satisfaction, less defects, better quality. It translates into better profitability. Better profitability translates into the increased shareholder value, and your organization becomes sustainable. So this is the logical framework. Logical framework is understanding is a prerequisite to implement something. Because if we are not able to see a clear line of sight between what we do, it's not going to work. And this logical framework we do in our practical life. For example, you go in the evening for the jogging. So you draw a line of sight. Okay, if I jog on a regular basis, my health would stay in order. Logically, your blood pressure should stay normal. Your cholesterol should stay normal. And then it translates into a better health proposition. And it makes you more energetic. You are able to work longer. You are able to have a better life, quality of life. So this logical framework, in the first instance, you have to draw yourself that is there a linkage between what I do? ROI is the subsequent thing to calculate. So before jumping to the ROI, it's important to do that. Now, this is one of the equation. As an example, I'm sharing with you. I was talking about the turnover. So if the performing people leave the organizations, there's a cost in terms of the recruitment costs, because you have to rehire. If you rehire people, you have to retrain them. There's a cost involved at the time of separations, and there's an unfilled vacancy cost. You even rehire another person. It takes certain time, couple of months to become fully functional. Even the person is professional. And in certain cases, if the person is involved with a direct revenue generation, for example, the branch manager, he or she may take away certain clients also, certain accounts also. So there are certain losses and there are certain benefits also. One of the benefits which is counted a lot, that's the saving of the salary. But if you get into the real calculation, these figures are available with the finance. If you're able to get into this calculation with the help of this formula, which I'm not discussing so far, you should be able to determine what is the benefit and what are the losses of when a performing person leaves the organization. So this is a concept, right? Okay. Now the ROI, coming straight to the ROI. ROI, as you know, is a financial term, financial tool. It's not the HR tool, which says the net benefit over cost. It's a formula. And one of these very robust mechanisms to determine that you have investment somewhere, how this investment is going to pay back to the organization, right? So before going to the HR ROI, let's look at the traditional ROI calculation for any traditional asset in the organization, right? Or even in the personal life. Say that you buy a shop in a mall and its cost is $2,000. I'm writing the dollars because of the reason that it's a commonly understood denominator. And the shop also has a maintenance cost on a monthly basis for 1 year, $6,000. And it's leased for 5 years, or still, if it is for more than that, you have to assign certain useful life for calculating the ROI. Remember, one of the prerequisites of the ROI, the time period counts. When you have to use your judgment, not a single judgment, build a consensus by the people who are more knowledgeable about it in this area. And then we sum up the total cost, that 200,000 is the initial cost plus 5 years on a yearly basis, 6,000. So $230,000, the total investment. Whether you call it investment or the cost, that is secondary thing. And then you're getting certain return. The return is $10,000 per month. You think that in 5 years, your rental would be $600,000. And then you calculate the net benefit by deducting the cost from the net benefit, 600,000 minus 230,000, 370,000. And the ROI formula is that net benefit over cost. And the net benefit is calculated by, by deducting the cost minus actual total benefit, right? So the net benefit is 370,000 divided by the cost multiplied by 100. It comes to a figure 1.6. ROI is expressed in percentage form, so it's 160, right? So 160 means that if you inject $1 in this project, after having adjusted its cost, it's going to give you 160, 1.6 dollars, 1.160%, right? So its ROI is positive, so it gives you, it motivates you to spend more over here. And with this traditional calculation, you want to see that what is the break even for this investment. The formula is cost over total benefit multiplied by period. So total cost is 230, total benefit is 600,000 multiplied by 60. So in 23 months, you are going to have a break even. Now I'm discussing the traditional ROI framework before going to the HR, because we need to be familiar. Okay. Maybe it's this kind of calculation could be something new for some of us, although it's quite simple. But before moving on to the other HR ROI, I want to ask you, are you able to understand this thing clearly? Is there any ambiguity on it? Because understanding this with clarity is a prerequisite to calculate the human capital ROI. Anyone? Okay, how many of you think that you are grasping the things and you're comfortable with it?
Very much comfortable, sir.
Okay, excellent. Okay. So Hassan, at never point I said that high engagement would stop natural attrition. I don't know what is natural attrition. By attrition, I mean that voluntary attrition of the people. So see the logical framework. Why the people leave? They see because of some financial reasons, some behavioral reasons, some issues in the personal life. So assuming the personal aspects which cannot be controlled by the organization, most of the things like the learning and development, the compensation, the environment for respect, the work-life balance, if the organization is able to take care of those aspects, the likelihood, I'm not saying that the 100% people are going to stay, the likelihood of staying in the organization would increase. This is a logical framework. And if you disagree with it, let me know. Because why people leave the organization, there's strong reason that, and the organization who are able to take care of those concerns, their retention ratio is better. So retention or the turnover is basically a risk management strategy, and risk is never zero. You have to minimize the risk. So what I'm trying to say is that with the logical framework, you can minimize the risk, you can never zero the risk. Okay, two people have raised the hand, Ahmed and Al Karim. Ahmed, over to you.
I would just like to add to your comment to Hassan. As we discussed earlier, that everything is linked to the stakeholders and the shareholders, right? So for employees, we must give them the same value as the shareholder sees in their investment. So maybe it can be the vision of the company, it can be the personal value addition they feel in their careers, so that they remain engaged. And at the end of the day, you're quite right that the risk is always there. You send them to trainings abroad, but still you'll see people, leaving the job. At the end of the day, it all comes down to the organization and how it is able to create value for its employees as much as it creates for its shareholders.
Right. And also demonstrate that value to the shareholders, because the reason that shareholders are the dominant stakeholder. This is a reality, right? In finance, it is said that accounting is a concept and the cash is the reality, right? So the thing is that they have a huge stakes in the organization. So yes, employees are the stakeholders, but they're not in the decision making. The decisions come from the top. So you have to create this value proposition and demonstrate to the dominant stakeholder that yes, we are investing in the human capital in the form of the engagement or the retention or the skilling. There's a payoff, and that would motivate them to invest more, right? If they are not able to see that return, that would be less inclined to do so, right? Thank you so much. Okay, Al Karim, you have some point?
Yeah, can you hear me?
Yeah.
Thank you so much, Zahid. It's a wonderful session. Very critical topic that you brought across, right? The framework answers many questions, right? It gives the basis of how HR can contribute and actually be considered a value participant, especially at the board level, because that's where, you know, many HR professionals feel that we are ignored when it comes to key decision making of the organization, which drives the strategy of the company. And ultimately, it's the people who are contributing to that strategy. So thank you so much for bringing this up. My comment was where, you know, in terms of human capital management, initially, yes, as you mentioned, to overcome that risk and to portray to the board of directors, right, that the interventions that were carried out in terms of maybe it's career development, training, promotions, everything which involves cost is paying off so that they can put in more, right?
Exactly.
Yeah.
That is the purpose, because my experience, not only in Pakistan, I've worked with almost 16 countries and at least more than 10 national standards bodies. They're experts, the American National Standards Institute, British standards, the French standards, the German standards, the Indonesia standards, Singapore standards, Australia standards. And I've frequently found HR people, including myself, doing most of the efficiency work. Oh, how many people hired? What's the cost per hire? What's the time to hire? Achha, what are your new hire retention index? Oh, the hiring is not linked to the retention is not linked to the hiring. How come you say? It's one of the key stakeholders. If you are, okay, increase the salary for us because it's important for staying in the organization. Okay, show me the correlation between the increase in the salary past years and its linkage with the retention in the organization. Or retention is not linked to the salary. If retention is not linked to the salary, why you're asking for the increase in the salary? So if we are making case for the taking responsibility, we have to make case for the accountability also. If we do not make us present ourselves for the accountability, ROI is the best thing. I'm telling you a clear example. Get out of this mindset of the HR and the finance. We are the head of investor. You are the investor. You have $10,000. You know, clearly, honestly, tell me, Al Kareem, if you want to invest in a stock or even in a gold or the real estate, what would be the single most component you would like to see before investing your money somewhere?
I would see whether it's worth it or not.
And worth in the form of a return on investment. Right?
Absolutely.
Give you after 1 year.
Always the value.
Yeah, so that's the reality that we, as an HR professional at any level, I'm using level any level because we have presence at the board level also. And I've clearly heard the board people that at the board meeting, we have nothing to discuss except for the salary. You know, what should be a salary of the person, you know, what kind of stuff we are doing it. So kind of analytics where you are able to clearly say that this is what, and I've done this arguments with some of the business people, I found them very friendly. There are two ways. Al Kareem, I tell you that if I ask you, give me 100,000 rupees for 1 month, and you'll think many times why I should give you. And if I tell you, give me 100,000, after 1 month, I'll give you 110,000. And this is what is this I demonstrate this way of doing it. And you will be more inclined to give me. So ROI, whether we like it or not, this is the reality. And I told you that accountant people, they say accounting is a concept, cash is the reality. So we have to think of operating in the reality mode if we really want to be sustainable. And as I told you, this model was developed in 1970s, 1969. Okay. So going to the framework, and I told you that logical framework, and please do not, you know, there are so many ways of not doing the things. I have also observed that as an HR professional, in the first instance, we count the ways how the things cannot be done. You know, that's not the spirit. Your spirit should be how the thing can be done, because you have to, you know, overcome the obstacles. So yes, there are challenges. There are loopholes in the measurement. I've given you a clear example. Depreciation is the biggest lie in the finance. But how many of us have ever challenged this lie that, okay, that asset does not become zero after 5 years, so why you're applying it? We all accept it because this is one of the principles. If you don't apply it, we cannot calculate the useful life of any asset, and there will be huge confusion in the organization. Okay, so my question over here, coming back to the conversation, that is everyone comfortable with whatever I talked so far? Could you please raise your hand, everyone, just to give me a clear sense that you are comfortable with it, okay? Okay, some of the people I never saw them raising any hands, so I hope it's convenient for them to, okay, right. Okay, thank you. So let's go to proceed to the next slide, ROI. Now, this is the formula of calculating the ROI, the amount returned for every dollar or the currency spent on human, not employment cost, but the overall cost of the workforce. I would like to amend this. It's not employment cost, but the workforce cost. Right. Okay. And this is the formula. And now the question is where the formula comes. The formula comes through a global standard, which is called the ISO 30414. It has got 58 clear metrics to look at the health of the workforce in a measurable term beyond description, beyond narratives. Remember, description is not a substitute of the metrics. Every financial statement has also got certain statements in the footer, but the statement should be used to qualify something. Statement should not be used as substitute for a number. Number is critical. So 58 metrics are there. And out of them, one of the metric, which is called productivity, the human capital ROI, where there's a clear formula. And we have derived from there because we offer global certifications for this. So I'm comfortable in using it. Okay, so two people have raised their hand, Imran and Junaid. I hope it was in response to my question. If do you have something to say, or it was because I asked for it? Imran, you want to say something?
No, just as you have asked, I responded to that.
Okay, thank you, thank you. So everyone, please lower your hand. So this is the formula: the total revenue minus total expenses in the organization minus total cost of the workforce divided by total cost of the workforce -1. You would see a slight different configuration in this formula as compared to the actual formula, but is exactly the same. It produces the same number. So let's look at some of the numbers. Numbers are that you're operating in a small organizations where the revenue in a year is 4.5 million. And your total expenses of, it's called operating expenses, are 3.7 million. Out of which your total workforce cost is 1.5 million, and other expenses, other operating expenses are 2.25. And your human capital ROI, according to that formula, is 4.5 minus the same formula, minus operating cost, minus workforce cost, divided by workforce cost, -1. If you simplify this number, you will get 0.5. ROI is expressed in 100. So multiply 100, get 50%. Now the 50% mean that if you are investing $1 in the organization, after having paid, its original cost is giving you 50 cents every year. So if it is positive, it makes case for more investment. If it is not positive, you need to think it for yourself. Don't make the things emotional. See it for yourself. Am I investing in the right direction? Is it translating into a better outcomes? And one more thing, I'll explain it just slide further. There's something in the finance which is called ceteris paribus. This is a key term. This is linked with the calculation of the ROI. If there's any finance professional over here, I would like you to explain this terminology for me and for everyone, that what does it mean, the ceteris paribus? Okay, Yasir, thank you. Thanks for the rescue.
Right. Thank you, Zayed. As far as I recall, I think it's an economic term. It basically means, it's a Latin term, basically means all other things remaining the same. So if you keep all other factors across two calculations, all other factors constant, that would give you the real effect of the calculation.
Absolutely. Thanks for the clarity. Ceteris paribus is one of the terminologies and the concept used in finance. For example, if in this case you're buying a shop, and there's something abruptly takes place in a city, for example, there's a blast. So obviously, and the security situation gets worse. So you would not have this kind of return on the investment. Or maybe there's some unusual activity, say there's a sports activity, some tournament, some global things takes place in your city. So might be that you get rental more, almost double than that. So before any calculations, just keep in mind that things would not stay static. Constant does not mean the static, but there should not be any fundamental changes around the thing, because fundamental changes around the thing distort the ROI, and the ROI is not workable, right? This is one of the financial principles. So likewise, over here in this case, when you are calculating the ROI, you have to see that if you are making an investment in the workforce, is it really required? For example, do you have a turnover problem? Do you have a problem with the skill building? Do you have a problem with the employer branding? Do you have a problem with the engagement of an employee? And then you spend over there, it would translate into the outcomes. And as I told you previously, in a financial framework, the outcomes would translate in two forms. In one of the two forms or both the forms. Either it's going to jack up the revenue, if it is being spent logically and judiciously, or it's going to contain the expenses, and ultimately your profitability, your revenue would enhance. So in this equation, if the revenue goes up, your ROI goes up. If the cost goes up and revenue does not increase correspondingly, your ROI goes down. So with these calculations, you can exactly determine. And when you plot this calculation for the series of periods, in the first instance, you see it for yourself. I've been investing, but I never had the opportunity to look at it from this angle. And as I told you, the formula, simple formula, net benefit over cost. So this calculation is given in the standard. Otherwise, this is a simplified way of calculating it the same way. Like the revenue is same 4.5, total expenses 3.5, workforce costs out of 1.5, total expenses 2.5. Segregate non-HR costs. So from a ceteris paribus purpose, you assume that now we are calculating the ROI of the HR. So take out the non-HR cost, which is 2.25. You're left with 2.25, and the formula is benefit over cost. So you want to see that you are able to generate 2.25 revenue with 1.5 investment in the HR. So benefit minus cost divided by cost. You simplify this, you get the same figure, 50%, right? In both the way you arrive at the same number. So with this kind of calculations at the end, it really helps you in making a business case. Business case in what way? That you traditionally, when we ask for the more funds, and the investors or the CEO or the CFO are logical to ask for the return. And we are not in a good position to promise the return, or even if we promise the return, it's in the intangible form. I say yes, intangible should be there, but intangible is not a substitute for the tangible things. You have to have tangible things, otherwise the things are not going to be very promising. See how successful you are in financial allocation. So there are two possibilities. You go to the CEO, you ask for the more funds, you ask for the ROI, you say skill building. Yes, it is important, but it would not be very convincing unless you are able to relate it with the projected increase in the sales, projected increase in the production, projected increase in your capacity building, projected improvement in your turnover and retention, projected increase in your engagement in measurable terms, reduction in your downtime, reduction in your defects, and then convert those tangible things into the measurable ROI, dollar value, because those things are in the business form. You have to assign certain dollar, because when you say turnover, right? So you talk about turnover, basically you talk about the loyalty. Now loyalty is a term. How you can convert loyalty into dollar value? You see, yes, there's a recruitment cost is being measured by the finance. So you want to calculate, okay, how many people have left the organization, what is cost per hire, multiply, get the recruitment cost, okay? What retraining costs, how many people have, what is your average training cost per person? How many people have left, you get the training cost, separation cost managed by the finance, and then the unfilled vacancy cost. Average revenue per employee per day multiplied by number of days jobs are vacant due to the unfilled separations, plus total cost of temporary workers, outsourcing, overtime, and then deduct the salary and benefit which has been saved in this time period. You get a clear absolute number. So what you're doing, You are assigning a value. And remember, there's no steel jacket value in this world, right? There are, you can say, the logical values. And if somebody has a better calculation, would be able to negate your value and present own values, right? So if you have done this thing with some kind of judgment, with some kind of due diligence, with some kind of consultation, which I've been doing as a practitioner, with sitting with accounts rather than challenging them, sitting with them, trying to understand what is my, how I appear in the P&L statement, and how I can draw meaningful information from a P&L statement, not just to look at the P&L statement as a past indicator, but how I can manipulate it for driving the performance in the future. Because whenever you're looking at these kind of instruments, you can operate in two ways. One way is called the thermometer. Thermometer, you just see to it and can't do much about it. But the other one is called thermostat, where you take charge of these things and are able to control, manipulate, not in a negative term, but in a positive way, and you leverage the future performance of the organization, right? So the better argument with the organization, with the better ROI could be that you can tell your CEO or any decision maker that yes, skill building is going to be supported with some of the dollar return. And here is the mechanism of doing it. It may be an imperfect way of doing it if you are doing it for the first time, but yes, that proficiency never achieved on the day one. Try it in making a pizza. You make a pizza on the day one that no one would be willing to eat it. But if you do it number of times, you'd be able to bake a better pizza. So that's all from my side. I think I try my best at how I can put across this message. With this background, we are refurbishing our existing framework of supporting the organization and, linking with their purpose. Every organization exists with a purpose. Logically, that purpose should be that is there to, serve the society, because people pay money for their services, and how we can relate. So ESG framework is one of the critical components to relate with your purpose of the organization in a measurable terms. So we are happy to provide you any kind of support and diagnostic by using the data analytics within the human capital. You are building your capability in the form of the coaching or the organization consulting, the benchmarking, and most importantly, impact assessment. That is where we lack. If you pick up any of the annual report of the organizations, you would find most of the department demonstrating their impact contribution to the bottom line, where the traditionally HR impact assessment would be some kind of a birthday cakes or the hiking or the excursion trips without any clear evidence how they're making difference to the organization. So this is where you can create a good value proposition. That's all from my side, and I'm open to any questions. Good news about those who have subscribed to the recertification program, that this webinar is eligible for, entitled for 2 PDs who has CPS CP certification, and my colleague is going to help you with this code, those who have subscribed to this program. And here I conclude my thought and open to any discussion or the thoughts from your side. Feel free to say anything. Do not get into any kind of judgment. Let us know your views. What have you felt about it? And do you think that the things are workable to apply in your organization? Thanks a lot.
Okay, thank you so much for the opportunity to get back into this webinar spree by HR Metrics. It's always been a pleasure to be part of your webinars and interact with all the wonderful people over here. It's just a food for thought that I was thinking. There are many organizations. Maybe it can be a government-owned organization. Maybe it can be an organization which actually has no competition. Basically, in growing economies, there's a lot of times that there are organizations which don't have actually much competition. So for them, the shareholder value or the stakeholder value is not as in a typical organization. And so how do you suggest we sell these ROI mechanism in those companies?
Right. So thanks for this question. It's very important. Basically, ROI has got certain connotations. One is the typical payback in dollar value, and other thing is the value you drive from it For example, Ahmed, you are traveling from Karachi to Islamabad and you book a business class. So you're not getting the return, but the kind of good experience, pleasant experience you want to enjoy, that is an ROI for you. So every organization, whether it's a small or large or the for-profit, non-profit, has got certain bottom line indicator for the success, right? And it's very important for everyone to relate itself to the bottom line indicators and see how you're adding value and how you can demonstrate your value for that organization. So consider ROI in that framework, because this final component, people also say that some of those who are in the non-commercial sector, they don't have the dollar return. They don't want because it's not part of their strategy. I said, forget about that if that is the case. But for a commercial organization, this should be our wish list to get into that framework. If it is non-commercial or any other organization where this is not desired, try to look for what is being valued by your key stakeholders and we provide a service in a way that you can see the linkages between what you are doing and what your organization wants. So, Ahmed, I hope it answers your question.
Thank you. Thank you so much.
Pleasure. Okay, Ali, any thoughts?
Assalamu alaikum, Zahid. First of all, thank you very much for this session. Very well researched, very well, very well taken up, bringing to us. Thank you for that. Just, a small question on the ROI. It's quite interesting.
Mm-hmm.
Actually, in my organization at Mullen & Phipps, we have developed this ROI thing for our trainings.
Mm-hmm.
And it's a proper way of converting it into into a dollar terms. I wanted to understand from the formula, from the two methods you have given. There's a 50% ROI.
Mm-hmm.
Is there any I just wanted to have want to discuss, is there any standard of getting a ROI where you can say that that's feasible and that's not feasible? I mean, any value like 50% value, what if it's 30% and what if it's 60%? How do you read it? I mean, how can we say that 50%, of course, 50%, 60% is better than 50%.
Mm-hmm.
And 30% is lesser than 50%. But what if it's 1% or 2%? So even that, in that case, we would say that it's feasible to invest on our workforce.
Right. Okay. So I'm happy that if somebody else also wants to contribute in responding, because I genuinely believe in the collective learning. I'll share my thoughts and then give opportunity to others. So number one is, how do you interpret? You interpreted this in this way, that since ROI takes care of the original cost. So in this case, if you have 50% ROI, it means that whenever you spend 1 rupee or $1, €1, you recovered your 1 rupee and then got additional 50 pesos or 50 cents on it, right? So obviously it is positive. So it's giving you satisfaction, there is no loss. And even if there's a loss, then you have to consider, are you using the right payback period? Is it the realistic one? So first response to your question is that how do you interpret? It tells you return on your investment after having paid back your original cost. Number two, what is good? What I understand from your question, how do you interpret? There's no standard for anything where you can say, okay, this is good. The good always depends upon your relative situation. For example, if previously your ROI is getting into 80% and now you stand at 50%, this should upset you. What is fundamentally wrong that my ROI is declining? Whereas if you previously stood at 30%, now it is 50%, you should be happy on it. It's just like the turnover, where the people say, what is good turnover? But there's no good turnover, good retention, good turnover. For example, if you already have a turnover of 8% and now you are at a 5%, you should be retention, or your previous return was 8%, and now you've gone to the, you can say it has reduced. So you should be happy. But if you're previously, already in a 15% and you've gone to 10%, so basically your previous positioning dictates where are you. And so far, I have not come across any ballpark figure where you can say, okay, this is acceptable. Sometimes people aim for 2000% ROI, and your CEO is the best person because he or she gets a business case from the various functions. HR business case is usually not on this. It doesn't have that precise calculations. And in my next session, which I promised is a public session after 2 weeks, I intend getting more calculations of how do you further drill down into it. But the other functions, when they make a business case like the sales, and within the sales also there are different units, they make an ROI, and the CEO is always decides from where the person can get the better ROI, where is more return. It's just like your being the investor. As I told you, you want to spend money, you have some surplus money, so from where you can get the better return. Sometimes the returns are lower also, but still you want to get over there because you have some other non-intangible or the intangible benefits. For example, your organization branding, your organization positioning. So at times you have to make a mix and match of intangible and non-tangible, intangible and tangible things. But in most cases, if you are looking at the ROI, you see it with respect to the what are the other options that you have. And wherever you get a better option, you would intend, as a human being, you intend to invest over there where there's a better return. So that's my response on that. But as I said, if somebody else want to comment or any other viewpoint on this, please go ahead. Ahmed, you have some point on this?
Yes, actually, there are two ways of looking into it, right? When do we decide that what's the right number? As we know that, most of the ROIs, typically an ROI is done after an activity, right? So it can either help us improve our current regime or, take preventive or corrective actions moving forward to increase the ROI. And secondly, it also depends on the risk aptitude of the organization. Maybe that investment is done in some futuristic technology. And right now it's not reaping its reward, but you know that after 5 years or 10 years, this will be the future, right? Maybe data analytics, maybe machine learning. So you cannot, the organization would decide that, okay, maybe I have a negative return on investment, but eventually this might go into, a positive return. And this is a need of the future. So that's where you maybe you might ignore those negative return on investment, and and you have a better future at sight. It's all about the risk aptitude as well.
Okay, thanks for your thought. One other thing I want to add, that there are two ways of making the decisions. It's said that you can have facts without thinking, but you should not be thinking without facts. For example, Ahmed, if I want to make, if you are, I know you have been serving at Hub and other places. So if I want to do something related to that, if I gather information about that, it's a way of making a better decisions, right? So for better decisions, whether it's a technology or whatever, avoid taking a gut-based decisions. People take gut-based decisions, okay? But gut should be supported by some kind of logical framework, okay? If it is a technology, how it is translating into outcome? Will it save time? Okay, how many number of minutes would be saved? Does it provide real convenience to the customer? If it's providing convenience to the customer to translate into a better customer experience, your selling is going to go up. So developing that logical framework, I told you a logical framework, because in the first instance, we have to make the mental constructs before going into the measurement. If you see a positive relationship between what you're doing and how it's going to translate into outcomes, even if you don't have the calculations, with the help of your intuition, you can still invest. But if there's no logical framework, no positive indicator, still if you do something, the chances of success would be little, right? So that's my take on that. Okay, thank you. Anyone else with any further thoughts? Yes, Usman.
Zahid Saab, thank you so much for such an effective session. That's more of a comment from my side rather than a question, and I would like to have your thought on it. As you just said that ROI is being emphasized by every stakeholder, especially the shareholder. However, what I felt is calculating ROI for certain roles and certain positions takes a lot of effort and a lot of investment in terms of manpower, in terms of time, in terms of a lot of things, right? But the same shareholder stakeholders are reluctant to put in all that effort and investment into calculating ROI for those many roles. I would say majority of roles in an organization. Sir, just would like to have your thoughts on it. Is it just my observation or is it the overall situation?
Right. I think again, a meaningful question. So Osman, we have to consider that getting into ROI requires a lot of sophistication. It doesn't really, we cannot acquire the efficiency by doing a webinar, right? You understand that to become an accountant, you need to spend 4 years in the books of accounts, right? So in my view, all these things on a sheet is your ROI. Because when you, for example, you are investing in the training, you get the people trained, that's a benefit. That's also intangible benefit. Benefit is equated with the term ROI, right? And you are basically, your competency acquisition is people become more competent. That's also an ROI. Your pipeline for the successes improves. That's also in the ROI. And the final is the dollar value ROI. Now, all these 3 buckets, which are also called the efficiency, effectiveness, and the outcomes, the outcome of the ROI is the third one. So it's a matter of shifting the gears. And I always say that be natural. Those of you who would have driven the manual cars, Usman, please respond to my question. I am going to ask you. If you shift the gear from 1 to 4, what happens to the car?
Definitely something bad.
Car is not going to move. It's going to,
True.
you know, yeah. So the thing is that many times I see people breaching the gear 2 and 3. For your existence in the organization, your third-party validation by your stakeholders is a prerequisite before going to the ROI. ROI is a hypothetical way of calculation on the paper. Before that, you need a strong endorsement from your stakeholders, your line managers. So yes, they should be the one who should say that, yes, now the skill set of the people in my department is far better, and you should have some evidence to demonstrate in a neutral term, not in the narrative term, because now there are these, I call the neutral term because there's a global standards around that. It's not Usman or the Zayed term, it's the HR professional term. You should have the succession readiness index. So this mid part, the gear 2 and 3, unless it is not applied and we shift straight away from 1 to 4, no one accepts us, and then it's bounced back. So it just like that. For example, in the sales department, you go for the sales, but first you demonstrate the increase in the sales, and then you calculate the ROI. Whereas if you do not talk about the sales, you do not talk about the increase in the sales, you talk about the ROI, no one is going to accept you. So my suggestion would be to, in the first instance, I'm not saying to you, I'm saying for everyone, build your credibility in the HR by doing this paid work where the others should say, yes, there's an improvement. And then your ROI would be acceptable. If your stakeholders are not accepting you and we are trying to hide behind the ROI, I tell you, it's going to bounce back, because the real on-ground performance comes through this effectiveness part. And there's a lot to do. But I find a huge gap over there. In most cases, this bridging part is not being done. Or if it is being done, it's more done in a way that we understand, not the way the profession operates. Remember, all the professionals, the accounting, the doctors, they have a formal way of learning the things and then practicing those things. Where in the HR, you might agree that most of the thing that we do, we see our supervisor doing that thing and then we do it. Or at the most organization doing it, we do not have a backstop where you can say, okay, yes, this thing is written in that particular standard. So now, fortunately, there's a time now The HR standards are coming up. Just 27 standards have been developed, more are being developed. So that is an opportunity for us to, first of all, get a recognition by the stakeholders and then go to the ROI. It would be acceptable. If your stakeholders are not willing to acknowledge your presence, it's not going to work. I have experienced this thing in the organization. So that's my take on that. Do you agree with this? What do you say, Osman?
Definitely, I do.
Okay, thank you. Thanks. Any further thoughts? I'm happy that you people have enjoyed. I'm also grateful to our local as well as the overseas participants. I know you are in a different time zone. The timing may not be very convenient to you. And once again, thanks for your presence. If there's nothing more to discuss, I would like to close the webinar and hoping to see you with some more interval. And I would like to do an opinion poll on the LinkedIn for the future topic. The aim is to discuss those non-traditional things where there's a great opportunity, connect the purpose of our job with the mission of the organization and share your contribution to the stakeholders in whatever way, in more tangible terms. That's my focus. Okay, all the best. And if you like, everyone, please just open up your video, wave your hand to everyone to make everyone's presence felt, and then we can close. Okay, all the best. Thank you so much, all the friends. Bye-bye. Bye-bye. Take care. Allah Hafiz.